Okay, welcome back, everybody. Here we are in our final session for It's Your Money in spring of 2021. I'm Trevor Murphy. I will be hosting, and we have our moderator, Peter Kote. Our financial advisor today is Carl Lachman, and we'll be going into the money in our mind. Today's charitable sponsor is one of my favorite charities, the Pacific Symphony, and we have Representative Gary Good representing the Symphony today, and he's going to talk to us about some of the things going on there and how you can help. So I'm going to share my screen, and then Pete, why don't you take it from there?
Gary, hello.
Good morning.
Yeah, good morning. How long have you been with the Symphony, Gary?
I just celebrated my 13th anniversary, Pete.
Congratulations. I know.
I just wish I had discovered California long before 13 years ago.
Where is that from?
Florida.
Florida.
Right.
Welcome. We'd love having the Pacific Symphony as a sponsor. I know it's been a crazy year. So why don't you talk a little bit about what is the mission and update on us on what's going on and what's the plans for this exciting new year?
Absolutely. Let me start by thanking you, Pete, and your organization for including us in this series of webinars. We've gotten lots of great feedback from the people who have attended, and we find it very worthwhile. And of course, we're happy to be here today sponsoring this session. And I'll just briefly tell you what the Symphony's been up to over the last 15 months. Obviously, we were shut out of the Segerstrom Center as of March 13th, but since then, we've taken on a wide variety of educational and community activities, nearly all of them done virtually. Some of them have been created by our musicians. Dennis Kim, our concertmaster, who you can see there under the June 3rd, organized 10 concertmasters from all over the country, the Metropolitan Opera, the Boston Symphony, and so forth. And they did a Zoom concert that they created virtually as one example of the kinds of things that are going on. We've produced some orchestra material. In fact, if you go on the website there to concerts, you'll see Pacific Symphony Plus. And those are programs that we've created virtually over the last 10 months. And there are 11 new ones this month, just to give you an example. And that's highlighted this week by our very first pay-per-view performance. We're doing a semi-stage version of La Traviata. It'll be our first opera. So we're looking forward to that on Saturday night. Of course, everyone wants to know, when is the orchestra going to be returning live? So I've got some news, and it's good news. We will begin with live concerts on July 4th, a special holiday concert at the Great Park Amphitheater. It's a tribute to Elton John, and fireworks and everything else imaginable. We'll do two other concerts during the summer at the Pacific Fairgrounds, Orange County Fairgrounds. One is the premiere of the animated feature, The Toy Story, with live orchestra. And then in September, we'll be doing our annual Tchaikovsky Spectacular. Everyone is looking forward, though, of course, to getting back to the center. And our first concerts in the center are the weekend of September 30th, and that'll be a very emotional time for us. I'm happy to tell you that philanthropy has really sustained the orchestra over this past year, and with some shared sacrifice by musicians and staff, we've been able to keep our organization intact. And it was a great appreciation of all that's happening in terms of philanthropy for the arts in our community. Legacy has been an important part of that. By coincidence, three gifts matured over this past year, contributing a total of over $4 million to our endowment. All our legacy gifts go to our permanent endowment. They're not used for operating activities. In the short time that we've had the Marcy Mulville Legacy Society, Marcy Mulville was one of our founders from Fullerton. We've received more than 100 commitments and members to the Legacy Society with estimated gifts of $15 million. We need to have in that endowment over time about $60 to $75 million to achieve a healthy financial balance.
Gary,
So
Gary, what does it take for one season? What kind of budget do you have just for one season of the orchestra?
Great question, Pete. Our budget for the 1920 season, our last complete season, was $23 million.
Wow.
This past year, we cut about 10 million from that. So we really have been financially prudent. Next year will be a hybrid as we get back to restoring our audience. So I don't want to take time from our presenter. We're just happy to be here. On the screen now, you'll see our plan giving site, which is www.pacificsymphonylegacy.org. And people can go there to get a variety of support materials in addition to the things that they get from your site as well. And they can always email me as well, ggood, G-G-O-O-D, at pacificsymphony.org.
You know, they always say the root of all evil is money. Well, this is some of the ways that money can just bring joy and pleasure to a multitude of people. So, Gary, thank you so much for being a sponsor. Really appreciate it. And we'll get into our program, the last one. I'm excited.
Okay. All right. Well, thank you. Thank you so much. So I'm going to share my screen for Carl. We're going to get his up here. His is asked first. Carl has been he's a veteran of our sessions, doing it a long time.
Yeah, he used to look a lot younger. But see, you know, in the financial planning business, you want to look a little bit older so you look wise. So
I've got that covered now.
Yeah, you got it covered. You're looking good. Bachelor's degree. I know it's been a long time, Carl, since you went to college. But having an economics degree is perfect for what you're doing presently today, don't you think?
Oh yeah, it's very helpful. And of course, math minor. I kind of had this bent from a long time ago.
Yeah.
Studied at UCLA when I got an MBA. My emphasis was in finance as well.
So, so how many years have you been a financial advisor or in the financial services industry? And then how many years have you been a fee-only fiduciary advisor?
In a few months, it'll be 18 years. And during that entire time, I was a fee-only financial advisor from the start.
Wow, that's you're unique.
Well, and our firm is unique too. We've only been a fee-only firm since we were founded in 1984.
And who were you founded by?
A gentleman by the name of Bill Camp. He originally was in real estate, and he found out that he really, when he was meeting with people and showing them properties, he really enjoyed helping them figure out how to afford a home. And so after a few years in real estate, he transferred into starting this firm with his son, Carl Camp. We've been in Fullerton, actually the same location since 1984, same building here in Fullerton.
Was the firm always fee only?
It was. In fact, it was very rare at that point in time in 84. My guess is there were 20 firms like us all along the West Coast. Bill Camp and Carl Camp were part of the organization that eventually became NAPFA, which is kind of the fee-only national organization for financial advisors.
Because he came from the real estate area where commissions was quite common. And so you would think that transition would have made into the financial planning world, but maybe he saw what commissions do regarding the relationship?
Sure. He didn't want to be questioned by his clients as far as how he was getting paid. Are you telling me this just because you want to sell me a house, or is it really good advice? And because he decided to switch out of real estate, he looked at the different ways he could get compensated, and he liked the idea that it would be very clear how he's compensated and why that put him on the same side of the table as the clients he was serving.
Yeah, let's go to right down to compensation. How do you all charge? And talk a little bit about the firm itself and how many advisors you have.
Sure. The way we charge is pretty simple. Depending on how much money we're managing for you, we send you a bill that's calculated based on the number of assets that we're managing for you. And you can either pay that bill by sending us a check, or we can take that money automatically out of your account. And that's the only way we get paid. We have 8 advisors right now, soon to have a 9th. She recently passed her CFP exam, and we manage just over $1 billion for about 850 families or clients.
And so each advisor has approximately 100 or less clients?
That's correct. So in the industry, those that are compensated by commission, it's not unusual that they have something like 500 clients.
Oh,
but
5,000 clients.
Well, sure. A lot of different ways they do it. But in our case, because of the way our firm is structured, and we're not just managing investments, we're doing a lot more than that. It's all included in our standard fee. And so we only work with about 100. A more mature advisor, somebody who's been doing it a little bit longer like me, I have around 120 clients. A newer advisor on our staff may be only working with, say, 50 at a time.
Yeah, and plus you got support staff, et cetera. You're not associated with anyone that gives you referral fees or sells annuities on your behalf, or et cetera?
Correct. We don't sell annuities. We don't sell insurance. We don't prepare taxes. If we refer you to another professional in the area that we think might help you out, they don't pay us anything for that referral. So it's very clean and clear how we're getting compensated, and it eliminates those conflicts that often come to play.
Yeah. Well, besides, Carl, that you're competent, you're also a very nice individual. You live in Newport Beach. You got 2 kids, I believe. Are they in college yet?
I have 2 sophomores. One a sophomore in high school, one a sophomore in college.
Wow.
And I actually live in Costa Mesa. I'm about 100 yards short of Newport
Beach. Humble.
As a financial planner, I knew that 100 yards, though, saved me a lot of money.
Yeah. Okay, let's go to the next slide.
Okay, this is a little bit about his firm. But I just want.
Do you charge anything extra for financial plan?
No, that's actually included in the first year of work that we do with you. You know, we can only really give good advice if we understand a client and their financial situation really well. So we write a financial plan and collect that information from our new clients, and it takes some time. Usually it takes a couple weeks of either talking to a client or having them fill out a questionnaire. We read through that. We take several more weeks to write a financial plan for them. And that just kind of forms a starting foundation to work together. They read the financial plan and let us know if we got anything wrong, because occasionally we miss something. And so we write that financial plan, we go over it with a new client. Once we're all on the same page, it's only then that we start filling out forms and moving money and actually making things happen. It's all planning right off the bat.
So do you charge anything for your first visit? That's one question. My second question would be, is there a minimum that you will, is there a minimum in order for you to have a client.
Right. We meet with folks for free. There's no charge. Meet with us for an hour, hour and a half. Get to know us a little bit. Bring your statements. Bring an annuity statement if you'd like our opinion on it. We'll answer any of the questions about your current financial situation, and we'll also explain about us. At the end of that meeting, it's kind of up to this person to decide if they want to work with us. We'll explain our contract. As far as a minimum, I believe our contract says $400,000 as far as in accounts that Eclectic can manage for them. Sometimes we waive that. It really kind of depends on an individual situation. Okay. We've had older folks meet with us who are in retirement. They have more money than they need or that they're ever going to spend, and they want their money to just stay in certificates of deposit, CDs. Well, there's not really much we can do for them. And we tell them, we don't think you're a really good match with us based on the fact that you want absolutely no risk. You have all the money you need, and you don't really want our advice. So at the same time, we've brought on younger folks who are saving a lot of money, who need help with planning, and maybe aren't quite at that $400,000 limit. So meet with us. There's no obligation. We'll help you out during that hour, help you get to know us, and we can kind of decide together if it's a good fit or not.
Okay, yeah. We have some, I mean, you got a lot of questions here, Carl. People are seriously interested in talking to you. A couple of them are, so you have X amount of, I forgot how much you said, 9 advisors. How many assets under management would you say each advisor manages? That's one of the questions.
Well, the total assets of the firm is a little bit more than $1 billion. So the average client, it averages out to something a little bit more than $1 million of account assets per client that we work with. And then breaking that down by advisor, it's somewhere in the range of $50 to $150 million per advisor as far as the clients we work with. But that can vary. I wouldn't look at that in any way to determine whether you're a fit with our firm. Come meet with us first, because the averages don't tell the whole story. At the same time, we don't have any enormous clients. Okay. Most of our clients are pretty close to that average. A large client to us, maybe we're managing $3 million for them. So we're very comfortable. We're very experienced at working folks, kind of the average people in Orange County that need a financial advisor.
And then do you offer any hourly based fee-based services, so to speak?
Occasionally we do. It's not super typical. Occasionally somebody needs kind of a project done. So we often prefer, if that's the way we're going to help, at least for now, we'll often just create a project contract. It'll list what we're going to do and the total amount. And that's usually very helpful so that a client that needs us just for one project knows exactly what the ending fee will be, and it's not an open-ended hourly contract.
Okay, last question is, so after they've hired you and they're on board with you, how accessible are you? Are there any fees for phone calls or future meetings? How does that?
There are no future additional a la carte charges. Our standard fee is all-inclusive. Some folks call us often, and usually those folks have, frankly, more assets. Their financial life is a little more complex, and they're paying us more. Other folks, maybe they only need us occasionally, and they call us less, but there's no limit. Of course, sometimes we're more accessible than other times. You know, we got through taxes. There was an awful lot of work to be done very quickly. We had a lot of clients and their tax advisors contacting us at the last minute. You know, nobody wants to do taxes early. Sometimes we get very busy, but at the same time, we use the technology that we have. We let our clients see our calendars. They can pick a time up to 6 months in advance for a meeting if that's the way they plan their time. We try to return all of our phone calls the same day. We try to return all of our emails the same day. And for the most part, we're really good at both of those things. We're very accessible, and we're here to serve our clients. So it's very important that we get back to them quickly.
Yeah. One of the things that, since this is the last week or the last session that we're going to do on It's Your Money, recommendation is, please, if you're going to seek out a professional, meet with 2 or 3 individuals and have them go through your present situation. There's always, we say, make the change very slowly, deliberately, and because whatever your next change is going to be, you want it to be the last change that you make. You want to build a relationship just like you would with a primary care physician, and the relationship doesn't happen in a day. So take the time up front to meet with 2 or 3 individuals that are ethical, that are competent, that are fee only, that are fiduciaries. And we'll talk a little bit more about that today. We're not trying to get you in the hands of a professional advisor. If you're doing well on your own, you're a married couple and you're got it together, and you don't have anxiety about managing your money, then encourage you to stay that way. But if you do need the help of a professional, by the way, I do not do my own investments or financial planning. And my spouse is a CPA, and I've been doing this for many years. I just don't prefer to spend the time that it takes to do it. So every one of us is a little bit different, but I just don't want you to feel that we're pushing you into a professional hands. No. Let's go to your outline, because I love this session.
Yeah, so before we get there, I just want to remind everybody, because there were some questions, that this is the materials page. Pete put a lot of materials on this week. The webinar will be recorded and put up there. All of the previous webinars are up already if you want to go back and review, or if you've missed any session. So please do that, and they'll be up. People ask how long they're up for. We keep them up until we do this again. So if we do live webinars in the fall, which I think we'll plan to do, these webinars will be up until then, and then the new ones will be replacing the old ones as we go. Okay, so Carl, I'm going to stop sharing, and you can go ahead and get your outline.
Are you going
up
to remove your face? There you go. And
you want me to remove my face, Pete?
And then Gary's is still up too.
Yeah, I'll get him.
We want the focus to be on Carl.
Okay, I'm ready.
Are you ready there, Trevor?
Yeah, I don't see Gary. Gary's not here anymore either. Do you see him?
Already.
All right.
I just have this panelist screen on my screen, but I have no idea what everybody else sees. All right, Carl, let's get going.
Okay. Well, this is week 8. The session is called Money in Your Mind. And let's move forward. Here we go. So Peter, are we always rational when it comes to money?
Absolutely not.
I mean, occasionally we make a mistake and we actually make a good rational decision, but it does seem that we're often very irrational when we think back at some of the money decisions we make. We really wonder, why did I do that? And well, what are some of the reasons? We often spend money we really shouldn't. And if we use a credit card alone instead of physical cash, all the studies indicate on average we'll spend about 15% more just because we use a credit card. It separates us from our money. We buy things on impulse. We often confuse when we want something, but we say we need it. They're different when it comes to spending money. And oftentimes we assume the stock market's going to go up, or it's been going up and it'll just keep going up. A lot of folks think that right now. It's been doing so well for the last year or so, they assume it's just going to keep going up. We're not rational. We lack knowledge sometimes, we lack discipline. But you know, the big part of this talk is the fact that in some ways our brains are wired in a way that makes investing difficult for us. Our brains actually get in the way of making good, solid, rational decisions about money. And if we can understand that a little bit, it'll help us going forward.
You know, one of the ways that I think it helps me anyway to understand it is the amounts of monies that I spent on commercial TV. Commercials are just super expensive, and these companies are not stupid. They wouldn't be throwing their money down the drain if to advertise. So even though I think they don't personally influence me, they must influence a lot of us, else they wouldn't be doing this.
Oh yeah, absolutely. And the repetition, there's something to the repetition. I've heard a marketing person say, the average person, before they make a decision on a product, they have to be asked about 7 times by that company, please buy my product. And it's only after about 7 asks that then they finally get to the point where they say, I think I'll try that.
Yeah, and people think that the financial services industry is just like buying a car. And so, or a new clothing or something that you eat. And so the commercials are designed to influence us.
Right. They try to set your mind at ease. They want you to know how easy it will be. Your worries will disappear. You just have to use us. We'll take over all of your worries. We'll make your happiness happen.
Yeah, we'll lessen the fear.
Right. So we're not super rational about money. We're also not very good investors. And here are some examples. The average investor left to their own devices over the 20 years that was studied here, in each case, they tried to invest their money better than an index, and in each case, they did worse. They didn't do as well as just putting it in an index and being hands-off with it. And another example, the way you kind of illustrate this is if you started with a portfolio of $500,000 and you would put it just in a 50-50 index, half stocks, half bonds, controlled by the index, after 20 years, it would more than quadruple. But the average investor who tried to do it themselves after 20 years was left with less than that by more than half. So here's a couple examples, studies where the average investor just doesn't do terribly well. Another way we hurt ourselves investing is that we try to time the market. And almost always when folks get in and out of the market, they decrease their performance because we do it at the wrong time. And this is an instance where if you just left your money in for this period of time, the whole time, in the index, you would have had the gold bar, the highest return. But if you take your money out for the first and single best day, you have less. If you take your money out, and we often do, we think we think we can time the market, and we miss some of the best days. And the best days are often after the biggest drops. So all of these different situations, the more days you miss, and we usually miss the best days, our performance goes down. Vanguard even has studied investor returns very specifically in different parts of the market. So for instance, this graph, you look at US small cap value equity. A lot of vocabulary maybe that not everybody in our audience understands, but it's investing in small companies. And the average investor that used an index fund in small companies versus one that tried to do it themselves, they did worse than if they had just stuck with that fund. In fact, even though we use the indexes, we can't stay hands off, and we do worse than our own investments would have done if we just hadn't touched them. So even a good person who's very rational, who's approaching this in a good way, usually can't leave it alone. And if they just leave their own investments alone, they do better. But currently, all of the studies show that even with good investments, they don't leave it alone, and they have returns less than their own investments would otherwise.
Yeah, this is almost my story. 8 years I had the S&P 500, and when I was switching over to another plan, sold it. Didn't see any movement. I thought it was a new world, and lost the uptick for the next 5 years on the S&P 500. And that's when I kind of finally realized I am not good at managing my own money because of my own emotions. I can't, if I see it, I want to try to change it.
This slide shows a picture of Richard Thaler. He won the Nobel Prize a few years ago in economics. He's kind of a funny guy. He divides people between normal humans and economists. He thinks humans actually think like humans, where economists do not. All of his peers, he thinks, are rather weird. But he does make some very good points. And this is what he won the Nobel Prize for. Peter, you and I knew this a lot longer before he did. If we'd just written a paper of it, maybe we would have won the Nobel Prize. And that humans are impatient, inconsistent, and distracted by irrelevant factors when it comes to money. And financial behavior is largely just a problem of self-control. We're irrational. We don't make logical decisions all the time when it comes to money. And we should be, but we don't. Actually, he's a financial advisor. He tweets, he has a blog, but he does these funny kind of, and insightful, back of the napkin sort of drawings. And the way he describes this is that it's a behavior gap. Our investment return, if we left it alone, would be higher than our actual investor return. But that gap describes how we just can't leave it alone. And we think we're smart, and we make these decisions and changes in our investments, and most of the time it results in a lower return for us.
Yeah, I love, he's at the University of Chicago, and the story that I love is because I was at Long Beach State University, that and you get a lot of people asking, well, what do you do with your own money? And so, of course, he's constantly asked, how does he manage his pension plan that he has at the university? And at the time that he was asked, he says, I invest with TIAA, which at the time was a not-for-profit insurance company that had just fantastic and investment vehicles and very low cost. But the thing that stood out of that conversation, he says, I figured out my asset allocation and I never, ever opened up the envelope.
Yeah.
You know, and I go, wow, because what do you want to do when you see your portfolio
Right.
on a monthly basis? You want to see if you can make a possible change. He didn't want to fall into his own trap of wanting to change that portfolio. So he never just opened up, he never became aware of that portion of his portfolio. By the way, he's a multimillionaire and he's done really well. He has his own mutual funds today, but he's very much a leader in behavior finance.
Right. Right. So we're not terribly good investors. We make irrational decisions. So let's dig into what makes investing difficult for us. And really, it comes down to our brains. If we think back to biology or an anatomy class a long time ago, we probably vaguely remember that our brain has different parts. There's the thinking part. There's the part that is our brain stem that controls our heart, our breathing. We don't have to think about digestion. Our body does that for us. And our brain stem, for instance, takes care of that. Some folks call it kind of the reptilian brain, the brain stem. And the thinking brain, all of that gray matter that we're familiar with, we've seen pictures of, that's the thinking part. That's where we think, we make decisions. But in between, part of the brain controls our limbic system, and that you could call our feeling brain. It's where emotions and reactions come from. So this brain stem, it's kind of doing things automatically for us. The limbic system or feeling brain, emotions and reactions, and then our thinking brain, where we solve problems, where we make decisions. Well, specifically in the feeling brain, there's something called an amygdala. And this is kind of the control center of our emotions. It is influencing us to follow instincts. It's where emotions come from and sometimes control us, kind of take over our emotional state. It causes us to make weird decisions from kind of a feeling point of view, where we feel like we need more information in order to make a decision, regardless of the logic. Yes, certainly, sometimes we need more data, but at times we just are looking for more data and we're just caught up in thinking that the answer's out there, but maybe the answer is not. We make mental shortcuts. There's some really good biological reasons why we take mental shortcuts I'll get to in a little bit. And then emotions, we're influenced by the media. You mentioned it before, advertising. Not only are advertisers good at entertaining us and controlling our attention, but so are the folks that are doing the actual show. And it comes down to the same is true for the news, financial news, advisors on the television, people that are interviewed. All of that is packaged in a way so that we can't look away. And it all seems like the truth because of the way it's packaged. Well, let's dig into this even further. Sometimes people talk about trusting your gut when it comes to decision making. Well, that's kind of an instinctual thing, and it's been studied. This is a book, for instance, and this PhD writes, we tend to trust our gut reactions more than rational ones because they happen so quickly. We think they must be true. We just have an idea and it makes sense to us from kind of our core, from our gut, and we go with it. And we think it must be true. But while that might be good, trusting your gut, trusting your instincts when it comes to, say, a life or death situation, jumping out of the way when you're crossing the street and a car is coming towards you, your gut and your instincts are not really very good at helping you with investing. So one of our instincts always is to act. I can't just sit here and watch this happen to my investments. I have to do something. That's a built-in bias.
Yes.
Usually action helps us. It helps us survive. We have to go get food and act and help ourselves survive. We have to do things so that we stay in good health. But it's wrong, we think, to just sit and do nothing and let things happen that are going bad. Our portfolio is going down. I have to do something. I can't let this continue. Well, most of the time with investing, doing a whole lot of nothing is the best thing to do. The way Warren Buffett talks about this, he says every person, when they get their first job, they should be given a ticket book that has 25 tickets in it. And for the rest of their life, they get to make 25 decisions about their retirement funds. And that's it. So maybe they're 20 years old, they're going to work for 45 years. Warren Buffett says they get to make no more than 25 decisions for the rest of their life. And if we were limited in that way to the number of investment decisions we could make, we'd make a lot better investment decisions, and it'd keep us from messing with our investments.
You know, having raised a son, and if I gave him more, well, you got 2 kids as well. If I give him more than 3 choices, it's almost like giving him no choice. It's confusing. And in the marketplace, in the financial world, you've got 18,000 mutual funds. You have 4,000 equities, bonds, hundreds of thousands. Your choices are just immense, and you're going to show it in a little bit, but there's not enough time to search all the information that you need to get at this. So doing a whole lot of nothing is just the way to go. And yet that sounds almost counterintuitive.
Yes, it does sound counterintuitive. And I wouldn't want somebody to think that they don't have to make any decisions. You have to decide to take money out of your paycheck and put it into the retirement plan.
So you have to learn how to save.
You have to learn to save. You have to learn at least a little bit about investments or get some good advice. And most retirement plans have good options these days. A lot of the junk investments, the high fees have been taken out of retirement plans. So you do have to do a few things, but often with investments, less is more.
Yeah, Daniel Conaham is a big one in this area, and he had convinced the Obama administration to allow employers to place people in their 401k plans, and they would have to make an affirmative action to remove themselves from the 401k plans. Just that simple act caused people, I think it was like a 35% to 40% increase in the amount of dollars saved by workers. Just that small little behavioral change.
Right. And that's becoming more common, that company 401ks, you're automatically in it. They're automatically going to take a little bit out of your paycheck so you get company match. And if you don't want to do that, you have to sign something and opt out.
Yes. Versus opting in, which just a small little behavioral change made just a huge difference in the amount of dollars that Americans save.
Right. This slide illustrates some of the emotions we go through as the market's going up. We're feeling good, we're excited, then the market starts going down. We start questioning our decisions, we get anxious, we open the statements too often. We're checking our portfolio lots and lots. And then, oftentimes when the market is the lowest, that's when we feel the worst. We think we have to act. And this kind of just illustrates that. It's also illustrated by one of these back of the napkin drawings by Carl Richards, where when the market's up, we're greedy and we think it's time to buy. And when the market's down, we're fearful and we decide to sell. Well, if we do that again and again, like he says, if we keep repeating that, buying when it's up and selling when it's down, we're going to be broke in the end. Really, we should be doing the opposite.
Is that what you think is happening today with the real estate market? I just find that the buying frenzy is just over the top. Where do you think we are emotionally that you see in the community from your own clients, or do you guys have discussion amongst your advisors if you go back to the emotional chart?
Well, we are in a market that has come up a long way. There are reasons to think that the economy is going to kind of plug along and do well. We probably will have a little more inflation. There are some worries out there, but as of right now, they're kind of muted. The real estate market is in a very unusual situation. The last time I checked, there are more real estate agents working right now than there are homes available. So it's something like there's 1.5 million real estate agents, but there's only like 1.4 million homes available. So it's a very unusual market. Construction was constricted. They weren't building homes during COVID. Now everybody wants to build a home and they can't get the supplies because all of the construction supply companies are ramping up, and they're going out and getting more lumber, but they aren't to the same place they were 2 years ago. So there's a lot of supply constraints, along with people who, if they lived in a high-rise apartment, they don't want to anymore, and they're trying to move out to a home. Interest rates are low. That's motivating them. COVID is motivating them, but the homes aren't there. And so homes are selling for a lot more because people are frankly being influenced by their emotions over COVID, their emotions, some fear, their emotions about interest rates. They're worried about those skyrocketing. Yes, they will probably go up, but they probably won't jump to 10% 6 months from now. They might go up 1% from where they're at now.
Be careful. Don't let the emotions run wild. There's nothing wrong with renting for a little while, and we'll see in 6 months to a year where things land. People have a problem with volatility. What does volatility mean within the financial services industry, or how would you define volatility?
Volatility is just a measurement on how much things are bouncing up and down. If something is stable, it's generally flattish.
And that's considered then low risk.
Lower risk. You can have high risk things that just aren't priced very often, so they look like they're not bouncing around much.
Okay.
But volatility generally is the bounciness, how dramatic that is in the stock market. It's a measurement that's used to kind of look at the stock market as a whole. And when you have kind of crazy days in the market that are dramatically going up or dramatically going down, oftentimes volatility is way up because so many things are moving dramatically in their prices.
And we don't see that in the marketplace, at least in the equity marketplace today.
Volatility is down currently. That's true. But if we have a big drop, you'll see volatility spike.
Okay.
But for the average investor, They shouldn't bother watching that volatility measurement. They should just understand that behind the scenes, their investments are jumping up and down all the time. And it's probably not a good idea to watch that closely because it will just make them fearful.
And it's normal for things to go up and
Absolutely.
down.
It's
This many people in the market.
It's very, very normal for that volatility to exist, but we can often see it as a distraction, and it causes a lot of folks to be fearful. So our emotions take over in these unusual situations. They cause us to make poor decisions. For instance, if you're angry, don't make an investment decision at that time. Don't react. Yeah, don't react to fear or disappointment and make a decision. Take some time off, do something else. Let the emotion drain out of the decision before you make it.
And that's one of the reasons why annuities are sold, because they say, let us take the risk of the market. You will not lose any money. Just remember, we are the major insurance company. It's one of the reasons too why banks and insurance companies always have these advertisings where they look stable, big buildings,
right?
Security.
We're here forever.
Yes.
We're not going anywhere.
We're just here to take care of you.
Annuities. I'm not as negative about annuities, perhaps, as you are, Pete. The problem is that the folks that sell annuities receive some of the highest commissions of anybody in the financial world.
And if somebody wants an annuity, there's some good reasons to have an annuity, but please see a fee-only advisor before you purchase one.
And there are annuities out there that you can get without any sales fee, without a salesperson. And those sorts of annuities, since they didn't have to pay a commission for you to buy it, there's no surrender fee. You can get out of it very easily without a cost. But annuities make sense in very, very few situations, and you won't hear that from an annuity salesperson. Annuity salesperson thinks everybody needs an annuity.
Yes.
So it turns out that we actually hate being embarrassed, and the studies show that we hate it more than actually losing money. And Dr. Thaler stated, what investors fear more than losing money is having to say what an idiot I am. We hate making embarrassing decisions. And so
somehow we're supposed to be endowed with how to manage money. People hate asking questions about money or saying, I don't know that much about money.
Right. We feel dumb asking the question, but really find an advisor that you can ask anything. An advisor that's competent and has the experience, doesn't care what question you ask them. They're never going to be caught off guard or be worried about the next thing you're going to ask. A good one will say, I don't know the answer to that, but I'll find the answer for you. And it turns out that this interaction of our emotions and fear are just the same as far as the fear for our physical well-being. Our fear of getting hurt in a car wreck is the same sort of fear as the fear of financial failure. Biologically in our body, it's the same response. It has the same effect. If you think you're going to worry about physical harm, and that's going to cause stress in your life, it's the same sort of stress in your life and the way it hurts your body as a fear of financial failure or a fear of a bad financial decision.
The biggest fear that they say that consumers have is outliving their resources.
True.
So that physical harm and the failure of financially failure, I could see being almost equal as far as causing harm.
Sure, absolutely. It's a big fear. We think more is better when it comes to research. We think if we just get another opinion, if we keep looking, sometimes we can spend way too much time and we get overwhelmed then by decisions. So again, our brain kind of gets in the way and will automatically cause us to start taking shortcuts. This is a very complex graph. It's communicating way too many things for the average person, and we get overwhelmed by this sort of thing. And our brain will just automatically try to simplify it. And I can show this to one person and they'll say, well, yes, this shows that the investments are going down. Another person will look at it and say, no, this shows that the investments are going up. Well, our brains can't analyze so many things at once. We kind of max out somewhere between 5 and 9 variables. I think this graph, if you count it and look at it all the different ways, it's about 40 different variables. So our brains immediately try to simplify it. It turns out there's a biological reason our brains try to simplify things, and that's because our brains take a lot of energy to run. About a fourth of all of the food you put in your body, the calories you burn, about a fourth is just to keep our brains working. So our biology, our bodies are always trying to conserve energy by figuring out ways for us to think less. If we think less, we'll burn fewer calories. Our brains take an awful lot of energy, and if we can use them a little bit less and take a mental shortcut, we'll save energy. We also take mental shortcuts in that we're biased to the ideas we already have. Again, a little back of the napkin, we have a theory, so we find evidence to support it. We don't ever wonder, maybe it's the wrong theory to have. This is a confirmation bias. So we get this idea in our head that a certain investment is right for us, and we listen to the folks that agree with us, rather than really doing the research and getting a variety of opinions. Another mental shortcut is we think that whatever has been going on is going to tell us what the future holds. And that's because we're unduly influenced by recent events. And we focus on the wrong thing. And this, again, a little drawing, we focus on and we get fearful of the last 5 days. What's happened in the market just recently, that volatility that you were talking about. But if we graph out the last 5 years, it's a much simpler graph. Well, what should we focus on? If we're smart, we focus on the long run and we don't get distracted by all of that volatility in the market.
Yeah, but the thing of it is that the entire media, newspapers, social media, even if you have a party with friends, they're not talking about what's happened in the last 5 years. Everybody's going to be talking about what's happened in the last 5 days, or do you believe what's happening in the real estate market today?
You're right. Absolutely. We go to a party, but you know what we need to remember is that our friends and folks we meet in those situations are not going to tell us about their lousy financial decisions. They're going to say, oh, my advisor made 50% on this great investment. They're not going to say, my advisor gave me 10 recommendations and they all stunk and I'm down 10%. No, they're going to focus on the one investment that is up. They're not going to tell us the whole story because it's embarrassing. In the same way, the news media watch the financial news. Every half an hour, they're interviewing somebody. Every one of those persons is interviewed, and they introduce them and say, this is the person that got the mortgage market right. This is the person that called it on GE going up. This is the person that knew Amazon. How many people do they interview and introduce? Now, this guy, he's gotten it wrong for the last 20 years. No, they're not going to have that guy on. And it's always recent because those people that they have on an interview, next year, they're going to get it wrong. They're not going to be interviewed anymore. So it's very selective what we're seeing in the financial news. When again, they're entertaining us. Let's remember that.
Okay, but this is a multi-billion-dollar enterprise. I mean, newsletters are put out saying, hey, my track record has been fantastic. You need to buy my newsletter so I can help you predict what the future is going to be.
The experts, quote unquote experts, many of them have figured out that if they say something that grabs people's attention and they happen to be right, it's going to make their career. So it pays to go on, be interviewed, and take a position that nobody else is taking, or to write a newsletter, because eventually they're going to get something right and everybody's going to focus on, this is the guy this is the gal that got it right. And that is going to cause a lot of money to flow to them to be managed. So we're so influenced by that track record and that success of that person. We think we can take, we make the decision in our gut. We jump to the conclusion, this is the person I should use. And we often don't look at, or we can't get to their true track record that goes back and shows all of their blunders.
Yeah. So just to apply that to mutual fund managers, if you have an active manager of a mutual fund, should you look at least 5 years? And should you look at how they performed in a down year if you're looking at their performance?
Oh, absolutely. A 5-year number is very good. For instance, 2009 was the prior big drop. That was kind of the bottom of the market. So for those 10 years, the 10-year numbers looked lousy. As soon as we got 10 years past 2009, namely 2019, all of the numbers started looking fantastic. The 10-year numbers looked much better. So 5-year number is a very good number. You should do a little more research than that, and you should understand the way the manager invests. So for instance, there's quite a few value investment funds, mutual funds that have a value approach, which means they care how much it costs and how the companies are valued. Well, those sorts of managers, if they're disciplined, they will run hot and cold. They will not always have a good year. It's guaranteed they will not always have a great year. And you can see it if you look at their performance. They will be up for a number of years. They will be down for a number of years. But if you look at the entirety or a longer run performance number, you will see that they've done very well over time. But you have to be willing to hang in there when they're not doing so good.
You guys, I just want to remind you, you got less than half an hour left.
What is hurting, Carl?
Well, this is what we're all familiar with. It's a junior high popularity contest. We all want to be with the in crowd. This is where peer pressure comes from. Sheep do it, and we're kind of like sheep. Where's the safe place to be? It's right in the middle of this herd of sheep. They're the one that's not going to get picked off by the wolf. It's the sheep that are kind of the stragglers that aren't as strong, that are not keeping up with the herd, that get picked off by the wolf. Well, peer pressure and the way we're wired, it's the same thing. It makes it hard for us in our group of friends, for instance, to be the oddball when it comes to our investments. All of our friends are investing in real estate, but I'm trying to make the decision not to be in real estate. I think actually I should invest in a different way. Well, some of us are influenced too much based on what other people are doing. And this is kind of a herding bias.
Yeah, when we came here from the Netherlands, we moved to Artesia and Cerritos because that's where all the Dutch people were. We wanted to be amongst our own kind.
And some of that's very normal, and
Yes.
we're more comfortable with people that are similar to us.
Yes.
But when it comes to investing, that's not necessarily a good way to invest.
Yes.
Moving on, we're influenced by the media. We've been talking about this. There are shows like Jim Cramer's shows. It's called Mad Money. It's entertainment. He has all kinds of qualifications. If you listen closely to what he says, if you look closely at the small text, the small print before or after his show, they say it's entertainment, but too many people watch it and then get an investment decision from him.
Susie Orman is the same way.
Oh, many of them are. And illustrated by the back of the napkin, where we let investing and entertainment overlap and then make a decision based on something from entertainment. It's a bad idea.
Yeah, but and we're not being critical of them. We're just saying don't take their advice as far as investment advice, because they don't know your risk tolerance. They don't know your net worth. They don't know your cash flow. They don't know your family circumstances, yet they're dishing out investment advice as if they knew you personally.
Correct. And many of our clients have a little tiny investment account that they hold on the side, and it's with E-Trade or something like that. And for them, it's an insignificant amount of money. Maybe it's a couple $1,000s, and they like to just buy a stock here and there, a couple $100 of this or a couple $100 of that. Sure, go ahead and do that. Just don't go all in the one thing that Jim Cramer thinks is great this week. Moving on, the news media, the financial news, they use all kinds of terms. Fear sells. Fear is exciting. When everything is normal and not going anywhere, it's a real dull day. So you got to watch out how things are portrayed in the financial news on television. And there are all kinds of examples on some of the terminology that we often hear. Well, it's a bloodbath today on Wall Street. The markets are freaking out. This company is too big to fail. The market is crashing. The terminology, right, makes emotions come up in us. And we tend to overreact to those terms.
I've been listening to a podcast called The Hidden Brain, and it's on NPR, and they also have a podcast outside of NPR, but it talks exactly about this, that the media tries to attract your amygdala, to bypass the cortex.
Right.
And it works.
Absolutely, it works. It keeps the eyeballs, it keeps their viewership up. They sell advertising for more money because of that. One of the famous Jim Cramer interviews was he was interviewed in February 2009, right while the market was almost near his lows. He was saying that folks should get out at that point. Well, he was pretty dang wrong. Getting out at that point was almost exactly the wrong time to get out. And the market only went up from that point. Fortune magazine, these sorts of articles come out every so often. They have the top 10 stock picks for the next year, the next 10 years. Check these out. Anytime there's a study of them, almost always you take your money and you make it smaller by following the top 10 lists. Again, the Barron's experts, another example where their picks not so great, and more examples in 2008, 2009, different pundits, different financial folks were interviewed. They said that things were not a problem. They went bankrupt a few days later. They ran out of money. Again and again. That was happening in 2008, 2009. Again, back of the napkin, Carl Richards, this advisor, that it's very common. These are the 10 top hot mutual funds you need to buy now, and next year you're wondering what happened. remember, mutual funds that are quote unquote hot, they're often the ones that have done very, very well. And they've gotten the press, they've gotten the media's attention. Well, nothing is going to be above average forever. In fact, the financial concept or term you need to understand is the reversion to the mean. Things revert to the mean, meaning they revert to average. They go back to average. So if something is up and is getting all of the attention, it's above average. It's going to go back to average. If something is in the pits and doing lousy, it's not going to stay there forever either. It's going to go back to average. So if you only put your money in the top hot mutual funds, the top advisors, they're not going to be there forever. In fact, there's a really good chance they're just going to go back to average. They had a couple above average years. They're not going to stay there forever. They're going to go back to average.
So probably your media is probably the worst source of information when it comes to investing.
Well, they're entertainers. You know,
Yeah.
That's what we should be calling them.
Okay.
I don't know if you recognize this guy, but this is Warren Buffett back in the 60s. There's a great clip, black and white clip, where he's asked, what is the market going to do? Well, the guy famously, he will talk and say generally good things about investing, about the markets. You can watch the Berkshire Hathaway shareholders meeting. They're very interesting. They go on all kinds of topics, but he doesn't give away his next big idea. He never says, I haven't done it yet, but I'm going to put $1 billion in this company. No, you find out about that months after he's done it. So he doesn't give away his best ideas. And in this old black and white clip, he famously was asked, well, what's the market going to do? And essentially he said, well, it might go up and it might go down. And that was his big insight. So anyway, we have these problems with our amygdala. The feeling brain really gets us off track. We follow our instincts. We let emotions take over. We think more information's better. We take mental shortcuts, and we're too influenced by all of these media entertainer folks.
And by the way, people who have master's degrees in their business administration and marketing, study this. And even in, they focus in on focus groups to see what words touch people off. It's used in politics. It's trying to pass the thinking brain, and it influences our investing, our political affiliations, etc. So it's very, and they're masters at it. These are not amateurs. They're really, really good at what they do. It's amazing. So if you think this is a sleight of hand trick, it's not. It's they put in an enormous amount of energy into phrasing and wording to try to pick that emotional spot in you.
Right. It's the same way that a really good song will get stuck in our head, and that's what we'll think about for the next day. It'll just be stuck in our head. Well, a good phrase, a good soundbite often gets stuck in our head the same way and will influence us unnecessarily. So what do we need to do to be better investors? There's a list that I came up with. Other folks say the same thing, but these I think are kind of the best things to first concentrate. The first thing is discipline. We need a disciplined investment strategy. Like we've said before, you don't want to make a decision when you're angry, when you're emotional. Find a time when things are maybe quiet. You're not in the midst of the storm. You're not distracted by the market crashing. Think through how you're going to invest and write it down. If we write it down on paper, we commit to it much better. when we start getting emotional, we can bring that paper out. We can remind ourselves what we plan to do. This is why we write financial plans for our clients. It reminds them, hey, we thought this through. You thought it was a good idea then. We said the market is going to go down at some point. Let's stick with our plan. It helps you stick with your strategy. Warren Buffett has said, success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control urges that get other people into trouble when they invest.
I love that quote.
Dr. Thaler, again, investors hate losses more than they love gains. They focus too much on the near term, even when it comes to long-term investment goals like retirement. They get distracted by what happened to their portfolio yesterday, and they make a snap decision. They just stick with the long-run plan and be slow to think that you have to act. Again, back of the napkin, Carl Richards' behavior gap. He also says, even a one-page plan dramatically changes the amount of worry we have about our money. Without a plan, our worry is really high. Even if we make a very, very simple plan, the worry that we have about our money drops dramatically. Diversification. Don't put all of your eggs in one basket. You may think that you have found the perfect mutual fund for everything. You don't want all of your money just in one basket, just like you don't want to put eggs all in one basket. This is an illustration, colorful chart. It shows what did best in major asset categories, investment categories, from 1990 to 2013. Look at the dark blue small cap growth. Small cap growth investments often do well, but it's not always at the top. It didn't always do the best. It jumps all over the place, and everything else did as well. Sometimes they're the top investment. Usually they're not. So if you pick just one, you're never going to have good investment returns all the time. Instead, you need diversification. You need a variety of investments.
Yeah, nobody can predict the future.
Right. And here it's, besides diversification, you need to also have a plan for allocation. At the simplest level, that might be half in bonds and half in stocks. Don't take this as a recommendation. This just illustrates how a way to split up your money into an allocation. You have a certain percentage in large stocks, you have a certain percentage in global bonds, you have a certain amount in international stocks. This is how you divide the pie in your portfolio. That's what an allocation is. Diversification is the number of investments. The allocation is how you split it up between the riskier investments and the more stable investments. Allocation is often one of the most important decisions. And there are studies that show this. The picking of individual securities, yes, it has an effect, but if you decide in advance how much goes to stocks versus bonds, international investments versus cash, that's actually a more important decision and has a bigger effect on your total return than picking individual things. Next, you need to rebalance, and twice a year is usually enough. If you start the year half and half, 50% stocks and 50% bonds, but stocks go down, then they end up being a smaller part of your portfolio, and you need to rebalance. And in that situation, you would need to sell 10% of the bonds in your portfolio and buy 10% stocks. You would get back in balance. Well, rebalancing is just forcing you to sell what is high and buy what is low. Bonds have stayed up. They're a bigger part of your portfolio, but you made the decision and you wrote it down that you were going to have a 50-50 portfolio. So sticking with that and rebalancing forces you to sell the thing that's high, bonds, and buy the thing that's dropped, in this case, stocks. So rebalancing is part of that discipline. If you start it and you rebalance, say every 6 months, it will force you to do something that otherwise you might not feel like doing. You want to look at costs. The fees and taxes will eat away your returns and make your portfolio smaller. So if you make some good decisions in that area, you will have more money in the long run. This illustrates the amount we pay advisors. It's very common and very competitive right now to get a fee-only advisor like us and spend 1% on our fee. But if you're not paying attention and you're going with someone that charges a lot more, for instance, an annuity salesman often takes 5% right at the start, that will dramatically erode your total assets if you pay those fees over a long period of time. And that's what this is showing. A 1% fee versus a 3% fee is something in the about 50% less, 45% less.
The average person who has a 401k plan pays 3% annually.
There are many 401k plans that still, if you add up all of the behind the scene fees, they are high. Generally, that's coming down. A lot of big companies, because there are billions of dollars in their 401k plan, like by a large company, they're paying attention to that better for their employees.
There's even financial companies that have excellent reputations where the workers had to sue them in order to bring down the fees. So fees are important. It's something you can control.
Yes. Taxes. This just a shortcut and get to the bottom line. This is just a study showing if you can use a tax advantaged account, a 401k, a retirement account, an IRA, put as much as you can possible into that, and then be wise how you use that money, you'll save on taxes in the long run. You're deferring your taxes to a later day, and often in retirement, we drop into a lower tax bracket. So if we can invest tax-free and then be taxed when we take the money out in retirement, we end up being much more efficient in our investing, and we save a lot.
We got about 5 minutes left there, Carl.
Well, my last point is that some accountability is really helpful. It keeps us from making bad mistakes. And a good advisor can be that form of accountability. Use the Ask First form, ask the hard questions, find out about their experience and their education and how they get compensated. A good advisor can stand in the way of you and a big mistake. Someone you can bounce an idea off of, a sounding board at the very least. Hey, I'm thinking of buying this new vacation home. What do you think about it? I'm thinking of buying this car and spending this much. What do you think about it? A good advisor can stand in the way of the way we're influenced, the way our brain, the way we get emotional, and can help us, keep us on track and keep us from a big mistake.
Thank you, Carl. Excellent presentation. Trevor?
Yes, sir.
Let's see, how are we doing on questions?
We've been answering them as we've been going. If anyone wants to, Pete or Carl, someone asked about, he really was impressed with you and wanted to know if someone lives out of state, can they still use you as an advisor?
Absolutely. We have quite a few. I think of our 850 clients, we have about 10% of those that live out of state. Did you say, where did you say the person lived?
Texas.
We actually make a trip to Texas, at least in the Dallas area, at least annually. There's a group of clients that originally lived in California. Their company moved and they all moved. So Texas just happens to be one that we actually travel to more often. But I have clients in several other states that I see very infrequently. I see them more, frankly, now that they're used to using Zoom.
Boom, yeah.
We have video meetings, we have phone meetings.
Yeah.
So yes, we have clients all over the United States. We're licensed in many of the other states. We have to follow the regulatory rules in those different states. I guess we're not actually licensed, it's that we're registered there. So we can help folks out of state, and I'm happy to have whatever sort of meeting would be helpful for that person to get to know our firm a little bit better.
If somebody let's say they lived in Idaho and they wanted to find a fee-only fiduciary advisor, where would you recommend that they would go as far as an association is concerned?
Absolutely. The best fee-only organization is called NAPFA, National Association of Personal Financial Advisors, NAPFA. And if you go to their nonprofit.org website, you can very quickly search NAPFA registered advisors and find them in your area.
Yeah, once in a while, when a client dies and their children step in, I continue on as a trustee, but they live out of state. So I will try to go up to the NAPFA website and try to find a local fee-only fiduciary advisor to help them with their financial lives. And they assist me then in managing that trust for those individuals.
Right, right. NAPFA is a great resource. They have some education on the website, and it's very helpful in finding fee-only advisors in your area. Only fee-only advisors can be a member of that organization.
Yeah. Any other questions, Trevor?
No, I think we're good. Everyone is financially literate and experts now.
We're going to give a certificate, right?
Yeah. No, we're going to give a credential. No, I just want to thank everyone for attending, and we've gotten great feedback. And I do believe that our online presence will be around as a site. We are planning. Hopefully, we'll get a lot of information, I think, in the next couple of weeks regarding the opening up of our society here, at least here locally in California. And we are definitely excited to be going back to live in-person sessions at our community sites. So
what I find amazing, and most people find it hard to believe, but if you have sat through all hour and a half, 8 weeks of this session with It's Your Money and It's Your Estate, you have done more studying information-wise than 50 to 60% of the individuals in the financial services industry. I know it's hard to believe, but it's true. Even professional fiduciaries, individuals such as Trevor and myself, they don't get this much education in their course of studies to become licensed. So I just want to congratulate you to participate and to be part of us, because we couldn't do without you. So thank you very much.
Yeah. And so we will be starting up a new series for It's Your Money. My best guess is about mid-September, the second week of September, we'll have a fall series. And tomorrow we have our final It's Your Estate.
If somebody is not registered for the It's Your Estate session, can they still register for that session?
Yes, they can go to our website. Let me see if I can find it.
Or they could send us an email and we can send them an invite.
Well, it might be easier just to go directly to the website and see there's a register here.
Okay.
Yeah, so if you go to the workshops button, then go to register, let's see what happens. Yeah, It's Your Estate. And then it should bring you up to, you'll have to just answer these questions real quick. And then you're registered and you'll get an attendee link. So
Carl, excellent job today. Gary, if you're still with us, thank you so much. We need you. Your sponsorship is awesome. And Trevor, thank you for being the technical guy and hosting this. Yeah. And Don did it last time, and we really appreciate him being involved as well. So kind of led the way. And it's a new era, this Zoom. So well, we're going to be probably continuing both in the fall.
Right. So, okay. Well, thank you, everybody. And thank you, Carl. Great job. And we'll see a lot of you guys tomorrow and the rest of you in the fall. All right.
Bye-bye.
Bye.
Thank you.